I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver?
Alasdair Macleod warns that the silver market is in the grip of a powerful physical squeeze, with lease rates spiking up to 100%, signaling there's virtually no metal left to borrow. He explains that backwardation, where the spot price exceeds futures, has reached over $3 at times, underscoring the immediate scarcity of silver in the market, though he notes some of these reports may be exaggerated. Even as backwardation has eased to around $1, it still reflects acute shortages. The root of the problem, Macleod says, is that most silver held in LBMA vaults is already tied up in ETFs, leaving very little freely available supply. As prices rise, investors increasingly view silver as a cheap alternative to gold, prompting them to buy ETFs, which in turn must source more metal, further tightening supply. This feedback loop makes silver behave like a jiffin good, where higher prices fuel even greater demand, reversing normal market logic. He then shifts to storage and ownership risks, stressing that physical possession or storage in trusted jurisdictions like Canada, the UK, or Switzerland is essential. Drawing on the 1933 U.S. gold recall, Macleod reminds viewers that assets held within the financial system are vulnerable to government intervention. He cautions against storing gold in the U.S. or in vaults owned by American corporations, noting the existence of an official U.S. gold price, $42.22 per oz, far below market levels, raising uncomfortable questions about what might happen in a future crisis. Finally, Macleod warns that owning ETF shares doesn't equate to owning metal. Investors merely hold a credit claim, with complex layers of intermediaries like DTCC or Euroclear standing between them and the asset. In a systemic meltdown, these entities can legally rehypothecate or liquidate ETF holdings while maintaining only a paper obligation to replace them later. His conclusion is blunt: avoid paper promises. Own physical bullion outright in jurisdictions with robust property rights to truly safeguard wealth.
There's no doubt there's been a huge, great squeeze. You can see this in lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. So, the lease rates have shot up. Typically they were sort of up to 30-40%, and there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. And the other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. People with silver sitting in Comex warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think, Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price. I think what you have to do, when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, I mean, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to exchange, to take your gold and gold under in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is $4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint, I would be less worried about because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, the regulator, through regulation, if you like. There may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated because you don't have a direct relationship usually with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC, which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights.
Alasdair Macleod explains that gold and mining stocks are deeply connected but behave differently during economic cycles. Mining companies are a leveraged bet on the price of gold. When gold rises, miners benefit. but only if energy and production costs don't rise faster. He cautions that miners often extract lower grade ore during profitable periods, so higher gold prices don't instantly translate into higher profits. He points out that gold ownership remains extremely low, making it an underowned asset with massive upside potential once confidence in fiat currencies falters. However, he warns that the current global credit bubble, driven by years of easy money and inflated asset prices, will eventually burst, as all credit bubbles do. When that happens, investors will likely sell profitable assets, including mining stocks, to cover losses elsewhere, which could temporarily hit the sector. Macleod emphasizes that the core holding should always be physical gold, as it carries no counterparty risk, unlike mining shares or paper claims. He then connects the discussion to the massive debt expansion that followed the COVID-19 crisis. U.S. government debt has doubled since 2019, fueled by suppressed interest rates and unproductive borrowing. As rates remain elevated, zombie companies and even the U.S. government face mounting financial strain. He compares today's auto loan market to the subprime mortgage bubble of 2008, over-leveraged, mispriced, and heading toward collapse. With the real economy weakening, rising defaults, job losses, and declining purchasing power, Macleod foresees mounting failures across sectors. Ultimately, he warns, the biggest failure may be the U.S. government itself, reflected in a collapse of the dollar's purchasing power. In this environment, every time the Federal Reserve cuts rates, gold will surge higher as the Fed prioritizes keeping the economy afloat over fighting inflation.
Basically, mines are a leveraged bet on the commodities that they produce. And if you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. I mean, you've got to look at the input cost side as well. And also bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable, rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of portfolios, if you like. Mines, on the other hand, I think are a bit more owned. And what I'm looking at is this is a credit bubble. Obviously, if you've got a debt bubble, which we have, the other side of that is credit. And more importantly, this credit has been applied to inflating financial assets, particularly stocks. Now, all credit bubbles come to an end. They pop. And when they burst, they usually burst quite spectacularly. 1929, October. 1987, October. October doesn't seem to be a very good month. I'm not saying that this October is going to be the crash, because, we'll look back on it and see whether that's true or not. But, when the bubble implodes, basically what people do is they will sell anything where they've got a profit in order to cover the things where they've got a loss. So that's the only caveat I would really have, I think, on investing in mines. But other than that, it's you can regard it, if you know what you're doing, as a leveraged bet on the underlying commodity. In the case of gold mines, it could be a way of you catching up if you want to speculate a bit as to, the route to do it. But your core holding always must be the metal, because that is the one thing where there is no counterparty risk. The fact of the matter is that there was an explosion of borrowing, debt in other words, when interest rates were suppressed at the time of COVID. You had businesses who were forced to stop trading and needed to finance themselves so they could resume trading once COVID was done. And as well as governments. You look at governments, the government debt in the US doubled between the end of 2019 and today. I think it was 23.6 trillion at the end of 2019, which was literally just before the COVID thing started, which I think was 23rd of March or something, 2020. And today we're looking at 47.4 trillion of government debt. So you've got all this debt, and it was all taken out when interest rates were suppressed, when the Fed was going in there doing QE and suppressing yields along the yield curve. So everyone's got all this unproductive debt, and it's basically turned a large portion of the US economy into zombies. And the US government itself, if it couldn't rely on printing money, as it were, is also a zombie. But, so I really do think that there's a time factor here. The longer that we have current interest rates, even if they just stabilize them, the longer we have them stabilized, then what you're going to get businesses falling over. And I think the car loans thing is a classic case, because that's just an agglomeration of debts, everything from good to doubtful to bad. And the idea is it was the old syndication. Do you remember the property syndication business we had in 2006 to 2008? There are liar loans in there, but who cares? We can slice and dice this so that the top quality, which we'll sell off to the pension funds, will be AAA. It's the same arithmetic, if you like. You just get a huge, great portfolio of all these car loans, and you can give them a rating which actually is far higher than it really deserves. Car loans. I think also the Main Street, as opposed to Wall Street, is not doing at all well. I mean, it really is not. So you're finding that people, they just cannot afford to pay these higher levels of interest, higher debt rates, and all the rest. Higher interest rates. They're not, they're losing their jobs. They're not getting the pay rises. Whatever. I mean, I don't care about job statistics. I mean, they're all wrong anyway. But you can see the underlying economy is actually deteriorating, and even though a lot of government statistics have been shut down because of the debt ceiling, I really do think that there are other indicators which show that the economy is just not good. And under those circumstances, you're going to see more failures. It's quite simple. Eventually, the big failure will be the US government. But that's reflected in a loss of purchasing power for the currency, which is why you have gold, and which is why when the Fed reduced interest rates a month or two ago, gold took off. And if they reduce it again, gold will take off again. And if they reduce it again, gold will take off again. I mean, because what's the Fed doing? Doesn't care about inflation too much anymore. The priority is to try and keep the economy going, keep the job numbers up.
Alasdair Macleod explains that gold mining stocks act as a leveraged play on the price of gold, but investors must consider costs like energy and/or grades, which can limit profit gains even when gold prices rise. While mining shares can amplify returns, he stresses that physical gold remains the true safe haven, free from counterparty risk. He warns that the global economy is sitting on a massive credit and debt bubble, inflated by years of cheap money and government borrowing since the COVID era. U.S. government debt has doubled since 2019, creating an economy filled with unproductive and zombie borrowers surviving only on low interest rates. As rates stay high, defaults are beginning to spread, especially in sectors like auto loans, which resemble the pre-2008 subprime bubble. Macleod believes that when this credit bubble bursts, it will trigger widespread liquidation across markets, even in profitable assets like mining stocks, as investors scramble to cover losses. Ultimately, the U.S. government's own debt load may prove unsustainable, eroding confidence in the dollar and leading to a loss of purchasing power. In this environment, every time the Federal Reserve cuts rates, gold will surge higher, a reflection of declining trust in fiat money and the system itself.